Welcome to this week's lecture. Today we're going to do a comprehensive overview of credit risk. Um, Whether you're studying, or you're working in banking or in financial services, or simply want to understand how lenders decide who gets a loan and at what rate, this lecture will give you a thorough grounding in the subject. So, what exactly is credit risk? At its most fundamental level, credit risk is the possibility that a borrower will fail to meet their financial obligations according to the agreed terms. In other words, someone borrowed money and can't or won't pay it back. This sounds simple, but the consequences ripple outward dramatically. When a borrower defaults, the lender faces a potential loss, multiplies that across thousands or millions of loans in a portfolio, and you understand why banks and financial institutions spend enormous resources trying to understand, quantify, and control credit risk. Think, for example, about the 2008 financial crisis. At its core, uh, this was an event that was driven by credit risk failure on a massive scale. Mortgage lenders extended credit to borrowers who couldn't repay those loans, uh, which were themselves packaged into securities. And when the defaults started, the entire financial system all nearly collapsed. Credit risk is not an abstract academic concept. It has real-world consequences of enormous magnitude. So these are the key elements that we will discuss in today's lecture. So first, the definition and significance of credit risk, then the potential for losses from loan defaults, the importance of assessing borrower obligations, the lender's role in that assessment, and real-world examples of what can go wrong. So one of the oldest and most reliable frameworks in credit analysis is the 5 C's of credit. Banks and lenders have used versions of this framework for generations because it captures the most important dimensions of creditworthiness in a memorable and practical way. The first C is character. This refers to the borrower's integrity and their historical record of repaying past debts. Lenders look at your credit history. Have you paid your bills on time? Do you have a history of defaults or bankruptcies? A long track record of responsible repayment signals something important about character. This is why your credit scores matter so much. It's a numeric summary of your behavior as a borrower. The second C is capacity. This is arguably the most analytical and rigorous of the 5 C's. Capacity asks, can this person actually afford to repay the loan given their current income and existing debt obligations? Lenders calculate the debt-to-income ratio, the percentage of monthly income committed to debt payments, and most lenders have maximum debt-to-income ratio thresholds, typically around 43% for mortgages, above which they will not lend. The third C is capital. This looks at financial stability more broadly, so net worth, savings, and assets. Substantial capital signals a financial cushion that protects repayment capacity even if income drops temporarily. It also reflects how much skin in the game the borrower has. A home buyer who puts down 20% has far more to lose, for example, than someone who puts down 3%, making them statistically less likely to default. The fourth C is collateral. This refers to assets pledged as security for the loan. If you take out a mortgage, The house is the collateral. If we default, the bank can seize the house and sell it to recover losses. Collateral gives lenders a safety net, which is why secured loans like mortgages typically carry lower interest rates than unsecured credit cards. The collateral reduces the lender's risk exposure. The fifth C is conditions. This is the broadest of the five, covering the external environment surrounding the loan, the state of the economy, the purpose of the loan, industry trends, and the regulatory context. Lending to hospitality business during a pandemic lockdown carries fundamentally different conditions than lending during a boom period. Lenders assess whether the macroeconomic context makes repayment more or less likely. Together, these five C's give lenders a 360-degree view of creditworthiness. No single C tells the whole story, but taken together, they provide a powerful, time-tested framework for credit decisions. They apply not just to individuals, but to businesses and financial institutions as well. So, how then does risk management come in credit risk? So now that we understand what credit risk itself is, let's talk about credit risk management, the systematic process of identifying, measuring, monitoring, and controlling credit risk to minimize losses. Credit risk management is essentially the institutional answer to the question, how do we lend money profitably while protecting ourselves from catastrophic losses? Two key points to remember here. First, credit risk management involves processes to evaluate risks both at origination, when a loan is first approved, and on an ongoing basis after the loan is made. Early warning systems and monitoring are just as important as the initial underwriting decision. Second, it ensures financial stability and regulatory compliance. So banks hold the savings of millions of people and are critical infrastructure for the economy. Regulators impose strict requirements on how banks manage credit risk because a major bank failure can trigger systematic economic damage. Effective credit risk management is, in a real sense, what makes responsible lending possible at all. Managing credit risk is not easy. So let's look at some of the challenges. First, data inefficiencies. So the data needed to make good decisions is often scattered across multiple systems, inconsistent in format, and difficult to access quickly. A lender might have application data in one system, transaction history in another, and external credit bureau data in a third. Putting all of that together reliably and in time for a decision is genuinely difficult in large, complex organizations. Second, lack of holistic framework. Many institutions have divided approaches to risk. Retail lending, corporate lending, and treasury each have separate models and processes that don't communicate with each other. Without an integrated view, it's easy to miss portfolio-level concentrations of risk or to apply inconsistent standards across similar borrowers. Third, outdated tools. A surprising number of banks still rely on manual processes and legacy spreadsheet-based tools for credit assessment. These are slow, error-prone, and incapable of handling the volume and complexity of modern credit portfolios. The gap between what cutting-edge technology enables and what is actually deployed remains wide at some institutions.